Welcome everyone to another episode of the Everyday Trader. This is Greg. Good to be with you today. Eric, glad you made it back from Iowa.
Iowa. Well, I did drive through Iowa, but I was
Oh, you went to Omaha.
Nebraska. That's right. I get to
Iowa's
hang
fun.
out with Uncle Warren.
How was it?
It was fantastic. I mean, it's the Woodstock of capitalism, as it's called, because it's a fantastic opportunity to go out and just to see literally two living legends. And they are very coherent and sharp. I mean, definitely showing signs of age. A 92-year-old and a 99-year-old, combined age of 191. I mean, almost as old as this country. In fact, Warren made a comment about that. Just to hear these guys talk and just, I mean, Warren is so freaking sharp. I mean, he remembers, in 1969, when I negotiated the deal for, some bank. And do you remember, Charlie, when we spoke to the attorney from, which law firm was that? He knows the name of the attorney, the law firm. He knows the details of every negotiation he's ever had. And the insight just flows out of them. It was really incredible. I had lunch with a friend today, and he's like, what's the key takeaway? And I would say that from the two of them, my two favorite quotes, and this is one I've heard from Warren before, and that is, for 250 years, it's been a bad idea to bet against the United States. And I think that's going to continue. He made the comment that if I had the choice of being born anywhere and anytime, it would be right now in the United States.
That's awesome. I mean, I have to agree with that too. There's so much talk online right now about, and not just online, sometimes in the mainstream financial media too, about this idea of de-dollarization. And I hear comments about it all the time. Oh, all these countries are jumping on board, and it's happening. The dollar is collapsing, and I doubt it. I doubt it. So we sorry, I was looking at you. You're distracted. You got your dog there with you.
Yeah, you heard the dog barking.
You're good.
BS guy at the door. So
you're good. So anyway, I agree with that. I think it's, and this is coming from, as you guys all know, I'm like been the perma bear the last couple of years, because for me, it's because of valuations. I think the market got insanely valued in 2020. I think we pumped so much money into the market that pushed all markets to these insane levels. That's why I became such a bear at the end of 2021. And I'm not done with it yet, because I don't think all that money's back out yet. And I still think we've seen ramifications, but I don't buy into the idea that we're going into a global demise and that America is going to lose its reserve currency status. I think we're fine. I think I have to agree with that. Long term, I'm going to bet on the United States too.
Yeah, I agree. I mean, I'm of the same mindset. It's hard. Somebody said something a while back about that this time, the division that we have in the country and how awful it is. I mean, you can focus on the negative stuff, but there are plenty of objective data that show that we are definitely in one of the best times to ever live. I mean, in terms of quality of life and healthcare, we focus too much on sometimes the negativity stuff. It's hard not to get wrapped up in it. So just rise above it. I always go back to the people say, well, we've never had division so bad in the country before. Well, there was a period of time where people were killing each other, so in this country. I think I mentioned that in the last one. Things have been bad before, but the other one from Charlie. And so Warren, is, lots of optimism and positive. And Charlie, I have the book, The Wit and Wisdom of Charlie Munger. It's a fantastic, lots and lots of really smart stuff in there. But his theme, and he said it a couple times, is to lower your expectations. So the secret to happiness is to have lower expectations. I think there's a lot of depth in that simple comment, that it seems like unhappiness tends to come from when we have expectations and things don't happen. But there was, kind of the comment too, was that, yes, there's a lot of good things happening in this country, and we can actually afford people doing stupid things because it's a resilient country and we've got resilient systems, but can only take so much stupidity because it is possible to screw it up. And I think overall the message was, positivity. Still the big question I have is, who's going to take over when Warren leaves? That was funny because they had a montage of videos that they showed there that started in 2001. People asking, well, what happens when you retire? And then they show 2003, and then 2006, and then 2010, and then 2020, and the same questions being asked every time: what happens when you retire? And these guys are not going to live to be 150, so they are going to be gone, at some point. And of course, Greg Abel and Jane are going to co-run the businesses. Although one of the things that I think is most important, there's a really good podcast out there, Capital Allocators. There's a really good book I read recently about capital allocation. And I do, you as a business owner, understand that that's one of the most important things you can do is where you align your capital. And if you look at who tends to be the best CEOs in terms of performance from a fundamental value standpoint, it's allocation of capital. And that is Warren Buffett's role. He does have the major approval on all capital allocation. So, and even still to this date. So it's a concern for me. I'm a Berkshire Hathaway shareholder, so I have been for a while, but is by nowhere near my largest position. So I'd be concerned if anything happened to Warren, and I'd need to be in the wait and see. But also, just speaking of big changes, is like when we think of what happened when Steve Jobs passed away, and I was very bearish on Apple for a year and a half, and Tim Cook has been able to prove that he could, really do tremendous things. And did you hear his comment about Apple?
I did. Yeah, he's pretty optimistic. So
yeah, and he said that. Oh, was that me? Something got filled. He said that. Apple is better than any other business we own. And he meant private businesses as well. So they own like Dairy Queen and Clayton Homes and all kinds of other small business, Borsheim's and Hellsberg Diamonds. Just the list is pretty impressive. You'd be surprised who they do own. But he said Apple is better than any other business that we own, which is quite a compliment. And he said really positive things about Tim Cook. Although I happen to think Apple might be near the top at the current valuation in the low 170s, but that's a different topic.
You bring up a good point before we jump into talking about our topic du jour with the CPI. But I want to go back to kind of something you kind of touched on with Warren and, his role and what they do at Berkshire Hathaway, what he's done so well for so many years, and why he's earned the title, the Oracle of Omaha, is his ability to manage risk, his ability to look into a company and make an assessment of, I'm okay with this company, and I like their management, I like their position. And then he looks at other companies and says, yeah, I might like their product, but there's risk associated with that. And I look at his move just in the last year with Taiwan Semiconductor and his acknowledgement that they're a really good company that really makes a good product and they're right in the middle of growth, but there's a level of risk that he's unwilling to take that's completely out of his control with the geopolitical situation going on between China and the United States. And so he decided as a shareholder, we're pulling out. We're going to dump our big position in Taiwan Semi. And that's how he's managed risk. And, it's really kind of the same thing we do, the way we manage risk at Options Animal in a way. I mean, we don't have these massive positions that we move in and out to control risk. But when we invest in times like this, we use options to control risk. I mean, right before we started, Eric, you and I were having a discussion about our upcoming summit that we're doing in Texas, in Austin. I tried to say Afton. No, Afton's in Wyoming. Austin. And we're talking about what we're going to plan there. And of course, I'm going to talk about the collar trade. Now, some of you who have followed me for a while know, well, that's kind of what I do. I talk about the collar trade. But it also is very fitting for today's market and to control risk, because the uncertainties that are out there, because of all of these situations that have happened with the Fed and with inflation and with COVID and with a war in Europe and all of the other, the debt ceiling and politics and all the other things that are bubbling up in the news, how do I as a trader control that the way Warren controls it with big, huge stock positions and really long time frames? Well, the way we can do it is with options. And we have the flexibility as individual investors to do whatever we want. With in as far as managing risk, we can be as aggressive as we want to be, or we can be extremely, extremely conservative and take risk off the table. It just comes down to an understanding of how to use the instruments. And so I think that's a really cool takeaway that you got from that with Warren, is just his perspective on investing, that is a concern for the company going forward, for Berkshire going forward. Are they going to be able to replace his perspective on risk management? It's a good question.
You mentioned Taiwan Semiconductor, and the question came up as to why he was in and out on Taiwan. A pretty significant $4 billion stake he had in Taiwan Semiconductor, and then the next quarter it was gone. And his reasons were specifically because of geopolitical threat that is concerning to him. Now, you and I, we've mentioned on this before. We talked about Jonathan Ward, who's an expert in China policy, and I've talked to Jonathan in the past about Taiwan Semiconductor specifically, and I know that he has a lot of insight in that area, and he's worked with the various administrations to help influence. Our policy on China is due in no small part to Jonathan, as providing some consulting to both the State Department, Department of Defense, and the White House. He told me that. Have you talked to Warren or Charlie about their position in Taiwan Semiconductor? And he says, well, I've made sure that they have my books. So, and his books are pretty straightforward. I think hopefully we get Jonathan on here in the future. He said he'd be willing to come on and talk for his new book tour. But I'd be interested to find out. I mean, you never know the reason why people do things, but keeping an eye on what's going to happen with China. This is something that's I don't know that anybody's really clear on where this is going to play out. So managing risk is absolutely essential. And as you talk, as most stock traders, your solution is a stop loss order, which really sucks. If the stock drops down, you sell your stock. And there's a euphemism out there by some active traders and institutionals, and they use this euphemism of price discovery. And the truth is, they're looking for these stops. They're looking for automated orders so that they can go out there and get other people's orders to trigger, and then hopefully take advantage of it. And I don't know if you've ever had a stop loss trigger, you lose, and the next thing you know, the stock's back up again. And you're like, why did I have that stop loss? Stop loss sucks. Stop losses, friends don't let friends use stop losses. If you use a collar trade, you can get much better protection, much better upside. But that's a little bit of scope creep, but you're absolutely right. Risk is so important. And I think most people don't even understand what the concept is. And options, if you use them appropriately, are designed to mitigate risk. And that's, but it requires knowledge and understanding.
So risk of the day then is CPI, right? We got our inflation report this morning, showed that there are year over year core CPI rose by 4.9%. Actually, no, core was 5.5%. Headline was 4.9%. Was basically right in line with expectations with the core inflation number of 5.5. The headline 4.9 was a little bit lower than expectation of 5%. And so the market liked the idea. The headlines, of course, surrounding that are inflation's, inflation is slowing down and we beat expectations. And so now all of a sudden the Fed's not going to raise rates, right? And that's what the market just priced in.
Did the market love it though? Because what did the market do today? The market looks just kind of like mediocre, tepid sideways. When we've kind of bounced a little bit, we're just basically chugging sideways. There wasn't much of a reaction at all. So did the market? I mean, it wasn't good news, was it?
I didn't think it was good news, but maybe I haven't opened up the market in a little. Yeah, you know what? We did. We sold off a little from the highs, so I take that back. The NASDAQ liked it. Microsoft and Apple liked it because the NASDAQ was up 127 points, up 1% today. But yeah, the rest of the market, I suppose, we have a mixed picture. We had some really good performance on the tech side today with Apple, Microsoft. Google and Amazon both having really big days today. Google up over 4% today. But software, semiconductors, healthcare, all really solid. the laggards of the day, consumer discretionary, or excuse me, consumer defensive, energy was off today. Capital markets, the financial sector is still, I think, reeling from the bank failures, and we've talked a lot about the bank failures for the last month or so. I don't want to beat that horse any more than it is, other than I'm still not sure that it's over with our financial credit crunch that we've been dealing with. So yeah, I guess we kind of had a mixed market today. I say the market liked it today because what Microsoft and Apple represent, what, 15% of the S&P now. So, and if you add in Google and Amazon, you're like 20% of the S&P 500 as far as market cap goes. So those four stocks liked it anyway.
Yeah, for sure. So we get a nice quilt here. You can see this is from FinViz that looks at the performance so far today. And we've got a lot of every kind of color on here. We got some bright red, we got some bright green, and you're right. The Fang Buzz, well, it's not Meta's Facebook, but I guess is it Magma now? I don't know what the abbreviation is, but Google, Amazon, Apple, Microsoft are, and look at NVIDIA up there in terms of market cap. It's Tesla flat, Meta flat. So the market was somewhat tepid, I think, from the news on this inflation front. Now, I'm going to flip over to the CME FedWatch tool, which shifted to, so this is the next meeting is June 14th, and we're at a 99. I'll refresh that to see if it's changed a little bit. But we're nearly, okay, so it's come down a little bit. That's better. We're at a 93.9% chance of the Fed staying at the current rate of 500 to 25. This was 0 earlier in the day, or like 0.1. I'm in the camp. I would put my money that we're going to raise rates again. And although I need to balance that, because while we were preparing, you and I were talking before we started recording, is Fed Chairman Nick Timiraos. That's a joke. He's been called Fed Chairman because, or the Fed Whisperer, because Nick seems to do a very, very good job of prognosticating what the Fed is going to do in terms of policy. And his piece today is saying that a summer break appears likely. And he's basing this based on some comments that you're extrapolating from some comments that were made from Powell in last November. I would argue, you and I sat down and talked with Waller, and if you look at the CPI numbers, we're in line, but it's basically it's not coming down. Now, there is something to be said for lag effects of Fed policy. And then also you mentioned banking crisis, tightening credit conditions that'll also have some impact. I think the lags are actually, people talk about the fact that Fed policy takes a long time to play through. Goldman Sachs did a piece that showed that over 80% of the impact of a Fed policy adjustment is felt within 2 quarters. So that's less than 6 months. So some people have said that it takes 6 to 8 quarters for policy to be fed. And I think the Fed is certainly in sync with Goldman Sachs, or Government Sachs, as it said. They've got a lot of economists that are doing similar research. I think the Fed knows that its impacts are felt sooner than what maybe. I haven't heard anybody. People talk about long lags, but show me the data that supports that. I can show you reports that show that it's less than 6 months. So argument that still this last rate hike still could take a few months to play out, but we're not seeing CPI come down. It's not. Where's the chart? I'm not seeing.
I have some real-time data that I could share.
Yes.
I did an experiment today. I did some market research today that I am regretting, by the way.
Oh,
so I went and did some market research and had lunch, ate a Big Mac for lunch. This Big Mac right here cost me $5.39. Now, pre-COVID, the price of that same burger at McDonald's was $3.79. Went and did some market research, historical research. That's $1.60, or a 42% increase in the price of a Big Mac in 3 years. That's an average of 13% a year that burger has gone up in value. Now, in that same time frame, I know the argument is, well, you're making more, everybody's making more money now. Yeah, they are, but they're not making 42% more money. Everyone's making, on average, and this is from the Bureau of Labor Statistics, the average weekly earnings in the United States pre-COVID was $935 pre-tax, and it's now $1,095 a week. So we've gone up $160 a week, or about 17% over the 3-year period. Our wages have gone up compared to the price of a Big Mac is 42%. And I know that's a Big Mac, and some people are like, oh, well, McDonald's, it's food. It's an example of a product that I think almost everyone in the country has tried at one point in their life. Maybe not everybody, but pretty close. Most everyone's eaten a Big Mac, so it's something we're all familiar with. And my point is I know maybe the rate of price increases are slowing down, but they're still increasing at a faster rate than that is sustainable for the average worker in the United States. And that's the pinch that the Fed knows they have to control, because right now there is an untenable situation being created for the working class that they can't afford rent, they can't afford groceries, they can't afford car payments, and they're going to start defaulting on student loans that are due here in that are going to have to start being repaid here in a couple months. And that's why I agree. I'm in the same boat with you, Eric. I don't think the Fed is done yet. And I think they would rather err on the side of tightening for too long and pushing us into a recession that's a financial driven recession, rather than a crisis of inflation that could cause just a major societal.
Greg, why do you think that? Is it because you've actually been told that by voting members of the Fed?
I've actually heard that from a voting member of the Fed, a governor.
Exactly. And that person is Chris Waller. We talk a lot about Waller because he's our best bud. We've met other Fed presidents as well, but they're not as forthcoming as Waller. And Waller, by the way, is speaking tomorrow in Italy at 10:15 a.m. On a conference on climate change and financial system risk. I already pretty much know what he's going to say because I've heard him speak about that in the past. But I am certain that based on today's report, so you and I had the pleasure of seeing him speak the day after a CPI report. I don't think these are accidents, the way these timings work out and who's speaking when. We saw him speak in Jackson Hole the day after the CPI report that back. Where was it? The one that just blew us out of the water. Yeah, it was this report here when we went 8.25. We were in Jackson Hole when went to 9.06. That was the report that we were there, and he told us that he spent the past 7 hours talking to Jerome Powell, looking at his speech. And this isn't a significant. We came down a little bit on the overall headline number, but the point we've made is that the trajectory of these lines is not what we need to. It's the slope of these lines. Yes, they're heading down, but we need to get them down to 2%. And these numbers, if we get numbers just like this, and we're talking years before we're going to be back down to 2%. The Fed isn't going to let inflation stay that high for that long.
They can't. People can't afford, like I said, people who are only making 5% more than they were making last year cannot continue to afford rent payments where they are, because real estate prices have held up relatively strong, which means rents have held up relatively strong. I mean, I don't know in your area, but all of a sudden homes are moving in my area again. People are selling houses again, and there's a resurgence in the real estate market. So everyone who's talking about, rent of shelter is going to drive everything down because the real estate market's crashing, it's actually holding up okay right now, which means that inflation could be stickier than longer. So I'm in the same boat with you. I think the market's got it wrong of where they're expecting the Fed's next move to be. I don't think the next move will be a cut. I actually think it's much more likely they continue to raise, albeit not a lot. I think they've accomplished most of what they wanted to do. I think we're probably just looking at 1/4 point increases for a while, but I wouldn't be surprised to see that either. one of two things as we approach the June meeting. Either the market starts to price it in and we start to see the Fed fund futures creep up and up and up and eventually accept the fact that the Fed is going to raise again. And maybe we get that from speeches like you said that Waller's going to give tomorrow. If it doesn't, when the Fed does potentially come out and raise in June, this is the other potential reaction. If the market stays that it's expecting a pause and we get a rate increase, we could have a really violent reaction in the S&P to the downside if that happens.
Well, we're going to have a lot of Fed speakers going on between now and June 14th. So I expect that we'll see the narrative change, and keep an eye on those numbers. I'm just shocked that the probabilities are as strong as towards us pausing here. The Fed's position is that when they're done, they're done. They are not going to restart. They would, and as you said, they would rather overshoot. And so I'm amazed at what people, no, I give Nick Timmeros does talk to people on the Fed. So if anybody has some insight, it's him. I keep a close eye on what Nick says. So that tempers my comments a little bit. But this is can you see the CPI report here on the screen right now? Am I sharing this?
Yeah. Yep.
Yeah. So these are the individual items. These are the month over month. By the way, those are orders getting canceled. The market's closed. So I had some open orders. They're all getting canceled. That's what those dings were. I hope anyways. Let me double check and make sure I'm not getting filled on stuff. Oh yeah, no, those are all getting canceled. Okay, good. All right. So the way that you read this, so all items month over month were up 0.4%. And how is this 0.4% calculated? Each one of these items that are on this list, and this says, 53 items on it, that are the level 4 indentation. So there's actually several hundreds, almost 300 and something items that are on here. Everything from cupcakes to chewing tobacco and streaming services. It's all in here. But the weighting, so this column is the weighting, and that's what these gray bars are. So this is sorted by the most important things. And as you mentioned, rent and shelter, the all-important rent of shelter. Now, this is not just rent. It is a calculation that takes into account not just rent, but also people buy houses. And so it does an equivalent number to figure that out. And that is still rising. It's increasing 0.5%. These are numbers going up. By the way, this is the fact that inflation came down to 0.4. It's how much it's increasing. It's still increasing. Yeah. It's just increasing less than it used to be. And I don't know, when I look at this, squint your eyes and look at the orange line. Which side are they skewed towards more? This 0.4 number just seems too low, because if I squint, the stuff that's not really important, we have some things dropping down way down here on the very low weightings. But if you look at just up in here, everything that's important is definitely skewed to the upside. We've got this medical care services that went down, and we all know what this is. This was a insurance premium thing that happened as of the first of the year. So that's artificially low. So transportation services, that's low. Education, communication services, okay, those are low, increased slightly. New vehicles down a little bit, good to see. But gasoline up 3%, that's a huge number. And then also recreational services, used cars and trucks up again, 4.4. This wasn't a surprise. We expected that number. But just going through here, there's a lot of things. The interesting thing is the biggest drops are fuel, oil, and other motor fuels. It's interesting that we've got a dichotomy between gasoline being up 3%, and we've got fuel oil down 4.5, and other motor fuels down 2.7. You drive a diesel. What are you seeing?
Diesel has not come down where I drive diesel. I've seen gas come down, but you're right. It is starting to creep back up again. We're approaching that summer driving season that usually puts a higher demand on the price of gasoline. And that could be why is we're driving more now that the snow's stopped falling, and, so demand on gasoline. You're right. I think this is as I look at that same chart, I see things continually to increase, and yeah, it's increasing slower, but it's still increasing. So that's the Fed's number one. As long as employment stays strong and inflation exists, the Fed's going to raise. They're not. The Fed
has tons of air cover. When are people going to howl we can complain about our 401ks going down, but the vast majority of Americans don't even check their 401ks or their retirement accounts. There's our community, you folks listening, you're all very much interested in it, but you probably know from your own personal experiences, most people don't give a crap and they're not looking at the markets as closely as we are. So CPI jerking around the markets, they don't care. What they do care about is the price of a Big Mac. Right. And how much they're paying for rent, and can they buy that retirement home? That's what they care about. And those things are, we're still going up as long as those people have jobs, that all stuff isn't, when people start losing jobs, when we start seeing unemployment above 5%, that's, the Fed has plenty of air cover until we get above 5% on unemployment. And we saw one of the strongest employment reports I ever remember hearing last Friday. So, and the market went up. I think there's a lot of hopium going on here, and people are, or maybe there's another narrative that I don't see, and I'm certainly open to that. But I think we're looking I'll be very surprised if we don't raise another quarter point in June. So, and that doesn't seem to be priced in or recognized by anybody yet.
And it could set the stage for a summer sell-off leading into the early fall. So we'll see. I agree. It's as imperative as ever to understand how to control risk. How we started our program today is, risk management is something that too many investors don't take the time to understand, but you've got to do it. You got to do it. You got to do it. Come learn how to trade options over at Options Animal if you aren't already a member with us. There's my commercial plug for the day.
Well, the commercial plug too is for people who are members. We're doing an event in Austin that I think is going to be one of the best. Well, our summits are always pretty awesome and they get better and better, but this is going to be one of the better ones. And specifically, the theme is what we're talking about here in terms of dark clouds on the horizon. There are I cannot remember a period of time when we were able to so clearly see a forecast of major potential events that have such a huge potential impact on markets. The confluence of things, I do not remember. I remember major things before, but I don't remember as many of them all happening at the same time. And we've talked about it on this, that we're seeing it in not only the yield curve, but we're also seeing it in the VIX futures. There is a significant amount of hedging that is going on. The market is bracing for something the second half of this year. And so for those of you that come to Austin to the Options Animal Summit, we're going to talk about some very practical firsthand stuff about what are we seeing in the market? How do we know the likelihood of these things coming to fruition? We've talked about debt ceiling. It's a huge problem. We've got this student loan thing that's going to be coming. We've got potential for a recession. We've got geopolitical risk. We've got fiscal issues. We've got monetary policy. We're still technically in a bear market. Yield curve issues. There's just so many of these things that we can see very clearly. And we want to do is take a very rational look, step back, be able to pay attention to these and then monitor them so that we know what to keep an eye on, and then come away with some really practical, concrete examples, what strategies are going to work. And for those of you that are interested,
tell everybody dates, location again.
Austin, Texas. This is the 23rd and 24th of June. So for those of you that are Options Animal members, check out our website. If you're not an Options Animal member, call and see if you can get in. We'll see if we can make arrangements. If you're local, it's great, but this is the kind of thing that these events, we try to keep the barrier to entry very, very low. You would pay $2,500, $3,000 to attend an event like this. The value you get out of it is you would get in a tremendous ROI at $3,000. Yep. But you're not going to pay it. For members, the barrier is low. It's your cost of travel to get there. And that should not take away from we'll even feed you lunch when you come too. Maybe not lunch, but definitely coffee and snacks. I don't know. Do we have lunch on the menu?
I actually think we have lunch on the menu. We'll see. Maybe I'm wrong. Now you guys are all getting mad at me when you show up and lunch isn't there. Just don't get mad at me. Get mad at my brother Joe.
No turkey sandwich. Okay. You definitely get coffee and some pastries and fruit, and in the afternoon, some cookies and some soft drinks, maybe even lunch. And it's not free, by the way. You've already paid for it. So
Yeah.
you paid
Come,
for it.
come spend, if you're not already signed up, come spend 2 days with us in Texas. Cause I'm going to reiterate what Eric said. I mean, there's so many things that any one of these things we're talking about, whether it's geopolitical conflicts or debt ceiling or inverted yield curves or inflation and the Federal Reserve and quantitative tightening and bank crisis. I mean, there's so many of them that one of them individually could move the market drastically, and they're all happening at the same time. So yeah, it's pretty imperative to understand risk, and we're going to spend a lot of detail over that 2-day summit. So come and join us. We're looking forward to it.
I was gonna share this other thing. I don't know if it's true or not. I know it's kind of a myth. And this, you've used this before when we've like during the middle of the financial crisis. I remember.
Well, then it's true if I used it.
What? Oh, that is true. Okay.
It's true if I used it. What is it though? I mean,
so the Chinese, yeah. So the Chinese character for danger is or a crisis.
Wei Qi.
Yeah, which means, what does it mean?
It means danger
and
opportunity.
Yeah. Crisis, danger and opportunity. So there's opportunity for you and there's a chance to win. In 2008, my portfolio was up 35% when most people were the best performing sector was down 23. And so based on what I learned to do here, I was able to pull that off. So
I was up 14% last year in 2022,
which is
on the year the S&P got crushed as well. So yeah, it works for sure.
Yes. And so understanding risk and knowing how to manage it. That's what we teach people to do. Didn't want to turn this into too much of a sales pitch because I know some of you like the fact that we don't do a sales pitch here. But I know some of you definitely would benefit, and the return on this knowledge is life-changing, nothing short of life-changing.
I'm trying to envision, is that Rocky and Bullwinkle? Oh no, that would be a squirrel and
am I sharing my screen
and
still?
a moose. Yeah, I just see two moose. They're in the Tetons. It's like my backyard. Yeah, there's still that much snow up there right
Your
now.
Backyard, you're just over the hill right there, right?
Yeah. All right, everyone. Thanks for joining us today.
Warren Buffett says, invest in yourself. And don't forget to like and subscribe.
Awesome. Thanks, everybody. We'll look forward to seeing you at the next one. Peace.
See ya.